What's up, sons? It's Blind Rod with Son of Attack once again, and today we're going to be talking about a bunch of stuff. Don't forget, today is the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. We have mining pools are the new mixers for cybercriminals. They are definitely coming down on proof of work for obvious reasons, right? I mean, proof of work is the best way to, and let me move this desk. Hold on. Is that gonna work? I think it's gonna work. The camera will stop bouncing in just a second. Oh, we have a new setup that we're working with here, so we'll work through it. But it's gonna be really interesting to see read this article basically saying that hackers have a new way to recycle their ill-gotten gains. We're also going to be taking a look at Bitcoin miners transferring $174 million worth of coins to exchanges in just 2 weeks. The Netherlands dismissed Binance's license application, and consensus lawsuit reveals JP Morgan owns critical Ethereum infrastructure. And that's getting even more interesting as we see today that it looks like Ethereum is increasing the maximum amount of ETH that you can have per validation node. Probably similarly related in some sort of way, I would assume. BlackRock's Bitcoin ETF would be a big deal, and this is supposed to be, obviously, we saw the pump and then the dump back down on Bitcoin after that happened. And crypto detective ZachXBT faces defamation lawsuits. And Bitcoin infrastructure firm Blockstream to unveil its long-awaited mining rig in Q3 of 2024. Then we have some crazy modifications going on the GeForce RTX 2080 Ti. It gets a 44 gigabyte memory mod. This particular mod does in fact also increase memory bandwidth. If only we could figure out a way to mass produce these, maybe we would have a cheap miner. That would be pretty cool. Let's get into all of that and more right after a word from today's sponsor. Today's sponsor is BT Miners. BT Miners has been a long-time sponsor of the channel and a proven reliable source for ASIC miners. If you're looking to purchase ASIC hardware from Bitcoin to Dogecoin miners, they are available for purchase on bt-miners.com. BT Miners is a trusted source by both ASICminervalue.com and CryptoMiner.com. Follow the affiliate link in the description and tell them SOT sent you to support the channel. And welcome back. So let's hop into the first and largest topic for the week. Mining pools are the new mixers for cybercriminals. This is according to chain analysis. Let me get a sip of water here. There we go. Hackers have a new way to recycle their ill-gotten crypto gains. Ransomware hackers have a new money laundering trick, mining new coins to replace tainted ones. Blockchain analytics firm Chain Analysis said in a blog post on Thursday. The firm located 372 exchange deposit wallets that received both mining profits and ransomware proceeds, Chain Analysis wrote. These addresses altogether have received $158.3 million from ransomware-related wallets since 2018. Quote, overall, the data suggests that mining pools may play a key role in many ransomware actors' money laundering strategy, Chain Analysis wrote. This fashion of money laundering is becoming increasingly popular, with ransomware-related wallets sending more and more funds to mining pools since 2018. Chain Analysis gives an example of a deposit wallet on an unnamed popular crypto exchange that received large amounts of crypto from ransomware incidents in mining pools. Of the $94.2 million worth of cryptocurrency sent to that deposit address, $19.1 million has come from ransomware addresses and $14.1 million has come from mining pools, Chain Analysis calculated. Although the funds always came to the exchange via intermediary wallets, Chain Analysis found instances in which the wallet receiving ransomware proceeds sent funds directly to the mining pool wallet, which then sent the coins to the exchange. This might mean that both the ransomware and the mining related wallet belong to the same owner who is using mining as a way to launder criminal funds, Chain Analysis wrote. Now, this is apparently one single case, and an important note here too is this is not the particular case in which the large amount is being touted as, right? So in the first case here, to be clear, the example of the deposit wallet on an unnamed popular exchange, this one in particular had 19.1 million from ransomware addresses and 14.1 from mining pool addresses. So the way this is stated, 19.1 million did not go into the mining pool and then out from the mining pool to the exchange address, which is really what they're trying to frame this as. They want it to sound like a lot of money, right? And then they want to tell you that it's going through mining pools. But in fact, what happened here is that somebody was mining to an exchange wallet, right? Or sending money from a mining wallet to the same exchange wallet that also the ransomware addresses were sending money to. So it isn't always this particular case, and I would assume that this is a much lower number because obviously when you're writing articles like this, you want to make it sound like it's a big deal, and when you're chain analysis, you want to make it sound like a bigger deal than it actually is. So that clarification I think is important, especially because it wasn't clarified in this article. This might mean that both the ransomware and the mining related wallets belong to the same owner, of course, is what they state. The thing here is, like, from a chain analysis perspective, you can still track this back to the actual ransomware addresses. So you can split that off and see how much each is. So this feels like to me more of a targeted attack on proof of work than it is necessarily a valid concern, right? Because if we were actually seeing it be used as full on mixers, maybe what you would see, where it would make the most sense, is that you would load up the payments address wallet from the mining pool itself, right, with the ransomware attack, and then pay that out to the miners. And then that way you could have some sort of mixing done. But as soon as this was found out, and as soon as it was basically in the public knowledge that this particular mining pool was performing this type of thing, users would more than likely move off of it because their funds, the fees that they were getting, or the payout and the rewards that they were getting from the mining pool, would be tainted with basically criminal funds, and nobody wants to have that. So it's a little funny. In this scenario, though, they go on to quote, "The mining pool acts similarly to a mixer in that it obfuscates the origin of the funds. Reminder, you can't trace crypto through services, mining pools included." I mean, can't you though? Isn't that what you just said that you could do? So let's go back here, right? If you say you can't, then why do you have these numbers? Well, first of all, these numbers are calculated because it wasn't laundered through a mining pool address. The money went from the mining pool to the same exchange as the ransomware also went to the same exchange wallet. So you were able to track that. And then it's stated here right after that chain analysis did find instances in which the wallet receiving ransomware proceeds sent funds directly to the mining pool wallet, which then sent the coins to the exchange. So if you do find those instances, I would say that you just contradicted yourself. It's a little odd. I believe you would be able to track anything that went into a payments wallet, essentially, pretty easily, right? From another wallet into a payments wallet, because that's all it is, right? A mining pool will have essentially two wallets. It'll have the wallet that receives the rewards, and they'll send those rewards to the payments wallets. Then the payment wallet will go out to the mining pool software. The mining pool software will hit the database, calculate the shares, and disperse that out accordingly. So I'm pretty sure that you can. and creates the illusion that the funds are proceeds from mining rather than ransomware, the blog post reads. The BitClub network scam, which pretended to be operating a crypto mining business until its operators were indicted by the DOJ in 2020, also used this scheme, Chain Analysis wrote. The wallets attributed to BitClub used the same set of deposit addresses on 2 exchanges as, quote, a Russian-based Bitcoin mining operation, Chain Analysis wrote without naming the mining firm. Oh, you gotta roll Russia into there if you really want to get people against something, you know. Just make sure you add that in right away. This might have been a trick to make exchanges believe that the funds are coming from mining, not from crime, Chain Analysis wrote. Exchange deposit addresses that received money both from scams and mining pools received a little less than 1.1 billion worth of crypto since 2018, according to the firm. I would like to hear what you guys, your opinions are in the comment section below, as well as in the live chat. To me, like I stated, if they are able to analyze this and see where everything is moving from, then it goes to show that it's not a great strategy for mixing in the first place, right? And from my knowledge of running mining pools in the past, a wallet, a payments wallet that is processing payments to different miners or whatever, is going to still be traceable at the end of the day. So if you're sending anything to that wallet, that's going to be on a majority of chains in public knowledge. I mean, obviously there's privacy chains that are going to change this a little bit. Something like Monero or whatever it may be, right? But that's going to be the same regardless, right? As long as you don't send it directly to the exchange, it's obfuscated to a certain extent if you bounce wallets around with any privacy coin. So I don't know. It seems a little clickbaity. It seems a little targeted. It seems like FUD against crypto mining in general, at least from my perspective as it stands. So I'd like to hear what you guys think. But miners are in the news still yet again, with Bitcoin miners transferring $174 million worth of coins to exchanges in 2 weeks. The 14-day average of miner transfers to exchanges has increased sharply to 489.26 Bitcoin, the highest since March of 2021, according to Glassnode. Now, we kind of knew this was happening, right? And this was earlier on, and this happened already. So the cycle, we're kind of covering this a little late. The cycle went, the Bitcoin moved to an exchange, Bitcoin dumped, and then we had the announcement of the ETF from BlackRock, and then Bitcoin kind of recovered again, right? So now we get to look at that with this perspective a little bit. Transfer of Bitcoin from miners to centralized exchanges has picked up the pace since May 13th, according to data tracked by blockchain analytics firm Glassnode. Data from Glassnode shows miners or entities minting coins by verifying transactions on the blockchain have moved 6,671.99 Bitcoin, $174 million to exchanges since May 31st. On June 3rd alone, miners moved 2,606 Bitcoin to exchanges, the largest single-day tally in over 4 years. The 14-day average of miner transfers to exchanges has increased sharply to 489.26 Bitcoin, the highest since March of 2021. Meanwhile, the balance in wallets associated with miners has decreased by nearly 2,000 Bitcoin in just 2 weeks. The movement of coins from miner or investor wallets to exchanges is often equated with an intention to sell or liquidate coins. As such, increased movement of coins from miners to exchanges is widely perceived as bearish. However, the recent transfers amount to just 1.3% of Bitcoin's 24-hour trading volume of $13 billion and do not appear to be big enough to have sizable impact on Bitcoin's price. Further, increased miner transfers are often taken to represent confidence in Bitcoin's price prospects. The logic here is that miners' profitability is closely tied to Bitcoin's price, and so they step up their sales when they feel the market is strong enough to absorb extra supply. This is akin to a central bank of a current account deficit nation buying US dollars in the open market when the greenback is on the offer across the board. That way, it is a able to build reserves without risking local currency depreciation. Bitcoin's price continues to hover around in a familiar range above the key support at 25,200. And then right after that, of course, what we've seen that kind of counteracts the idea that the sell-off may be happening was the increase in price of Bitcoin. We're at 26,766. You can actually come here on the chart on CoinMarketCap and kind of see where this happened. So if we were talking about the 13th when this article was written, we were right around here. I guess it was like here. And then we had that sell-off. So, I mean, it's potential that the sell-off did cause this potential dip, I think it was, right? Yep. It was 15th, 16th, and then we came back up and recovered. And a lot of that has to do, of course, with that ETF right here. So let's talk about that. BlackRock's Bitcoin ETF would be a big deal. This is a developing story, so there may be new news since the 16th. I didn't check yet today, and I meant to actually before the show. I know that it does look like it is getting approval through the SEC. I mean, obviously, part of that is due to the fact that, I mean, BlackRock kind of owns the SEC at this point. Well, BlackRock entered the chat early last year and it finally spoke up. BlackRock's iShares unit filed paperwork Thursday afternoon with the U.S. Securities and Exchange Commission for the formation of a spot Bitcoin exchange traded fund. As with all things perpetually online, many are tying themselves up and tripping over semantics. Is this proposed fund actually an ETF or just a trust? The question seems odd, but the tippity top of BlackRock's S1 filing sports this as the name of the proposed fund, iShares Bitcoin Trust. Before going further, as Bloomberg's Eric Balkanas tweeted, this is exactly how the SPDR Gold Shares ETF works. It's a trust, but it acts like an ETF. Without getting into deeply, if the iShares Bitcoin Trust is approved and functions with daily creations and redemptions, then it would basically look and act like an ETF. Who cares if it's technically a trust? The answer is many people. The market has some consternation with the word trust in the context of publicly traded Bitcoin instruments given Grayscale's Bitcoin product. The Grayscale Trust of GBTC holds Bitcoin, and shares can be traded or purchased over the counter for a price exposure to the underlying Bitcoin. There's consternation because GBTC shares trade at a steep discount to the net asset value. In plain English, according to Grayscale's website, the market value of a share of GBTC is $13.40, even though the amount of Bitcoin held per share is $23. That's bad for many reasons, but this shouldn't happen with BlackRock's products since it's basically an ETF. Really, though, the interesting conversation to be had about this technically a trust, but basically an ETF, has to do with how this will affect exchanges and paper Bitcoin. Bitcoin liquidity has suffered ever since Binance eliminated its zero-fee Bitcoin trading program earlier this year and FTX collapsed last November. The Binance news probably goes without further explanation, but on FTX, documents showed that its bankruptcy team had been unable to locate virtually all the Bitcoin the failed exchange owed customers. Who knows how much of that Bitcoin was just paper Bitcoins or IOUs. And that's nothing to say for the bear market, which has scared away market participants. With this market illiquidity has come volatile price swings. But if the iShares fund is approved and BlackRock comes into the Bitcoin market, there's a good chance this would cure any concern of liquidity problems. The sheer amount of attention BlackRock-sponsored Bitcoin ETF would garner cannot be overstated. BlackRock is the largest asset manager in the world. At a minimum, it would bring an air of legitimacy, and that air should breed a heavy inflow of money. Maybe that would increase the price of Bitcoin, but beyond that, there are two very important things to consider going forward that I will be watching. First, exchanges should be a bit fearful. If new investors want price exposure to Bitcoin and don't care about the aspect of it that makes it cool, like using it, then those investors will look to pay as little as possible for that Bitcoin. Why would an investor pay a 1% fee at an exchange when they could pay a tiny fraction of that through an ETF when they aren't interested in actually using Bitcoin? Second, with Bitcoin's fixed supply, is the introduction of a spot ETF from BlackRock going to supercharge the expansion of paper Bitcoin? The Bitcoin protocol says that only a certain amount of Bitcoins can exist, but the financial markets certainly don't say that. Financial markets allow the creation of exotic financial instruments that can represent pretty much anything, including any amount of Bitcoin. And that's kind of where things, I think, personally get a little scary, because if we're talking about Bitcoin changing the future of money by being a limited supply that is emitted over time, this kind of affects things twofold. One is you could basically have paper Bitcoin that is a promissory note, or, a paper Bitcoin that is an IOU for Bitcoin that is yet to even be mined, which could definitely drive the price of Bitcoin down. And that will affect Bitcoin mining pretty significantly. But in addition to that, right, you could have this potential of it, well, I mean, that's it, driving the price up essentially, because you have all of that already in place, or all of that 21 million kind of in IOUs in different areas, where you could have miners selling future mined Bitcoin to any paper holders, which would be a really interesting proposition. I think that this will also pretty heavily affect or potentially affect the traditional halving cycle of Bitcoin, right? Because if we get into this position where we have a bunch of paper Bitcoin, all of 21 million available, blah, 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 essentially for trading in the markets, then you get into a position where the final price of Bitcoin is already determined, right? To a certain extent. It will be kind of twofold. One, it will kind of supercharge the move into the lack of a halving cycle affecting price of Bitcoin, right? But it will also kind of artificially have to inflate the price of Bitcoin, both because of demand and because miners are going to be kind of playing some sort of hedge game where they're pre-selling Bitcoin. It could get really weird really quickly. Because the going US dollar market price for Bitcoin is dependent on the amount of US dollar an exchange would give you for Bitcoin, and the amount is governed by the market, what's to stop the market from being affected by immense speculation on derivative markets, which make the effective supply of Bitcoin tick over its finite supply cap? Potentially nothing, but obviously that's pretty much exactly what we were just stating. That being said, there are issues going on with Binance all over the place. We have seen a lot of exchanges moving out of the US, moving out of various other countries and so on. There's a lot of pressure on Binance right now. There's a lot of pressure on Coinbase. There's a lot of pressure on crypto.com. And that is obviously not good for the price of cryptocurrency in general, but the Netherlands dismissed Binance's license application as well here recently. Binance, the world's largest crypto exchange, has been facing significant scrutiny in recent times. The recent legal action initiated by the Securities and Exchange Commission against the exchange has been generating substantial attention. In addition to the ongoing legal challenges, Binance has now encountered another regulatory obstacle in the Netherlands. Earlier today, Binance made an announcement stating that it will be exiting the Dutch market. The exchange was unable to secure a virtual asset service provider license, which is necessary to ensure compliance with anti-money laundering regulations in the region. Consequently, this decision will be implemented immediately, and Binance will no longer accept new users from the Netherlands. Starting from June 17th of 2023, Binance will authorize existing users based in the Netherlands to solely initiate withdrawals of their assets. However, the exchange will temporarily halt other functionalities. This includes purchases, trades, and deposits for users in the region. In order to provide further clarity, the exchange is sending out emails to these users containing comprehensive information about the impact on their accounts and any assets held on the platform. The email will also include instructions on any necessary actions that need to be taken. Quote, Binance has been in a comprehensive registration application process as a virtual asset provider, VASP, with the Dutch regulator. Although we explored many alternative avenues to service Dutch residents in compliance with Dutch regulations. Unfortunately, this has not resulted in a VASP registration in the Netherlands at this time, end quote, said Binance. End quote, said Binance. Binance is going to be focusing on MiCA compliant. In its blog post, Binance emphasized its commitment to ongoing dialogue with Dutch regulators while simultaneously preparing its operations to align with the new European Union regulations pertaining to crypto assets known as MiCA. The exchange also reiterated its adherence to existing EU standards regarding anti-money laundering and counterterrorism financing. The exchange further highlighted its compliance with legal requirements in various regions, including France, Italy, Spain, Poland, Sweden, and Lithuania. There we go. I can do it. Anyways, so, I mean, we are starting to see an attack on exchanges in general. I think this has been going on for quite some time. There are kind of opposing opinions as far as this is concerned, because centralized exchanges are basically, from my perspective, an inlet and an outlet to participate between cryptocurrency and fiat currencies, right? So they're in my humble opinion, at this current time, a necessary evil for you to basically, well, work within the cryptocurrency industry and pay your bills. That's what it does. And that will not always be the case. And as cryptocurrency is more and more adopted, there will be less and less of a need for you to be swapping in and out. But as it sits right now, the power of manipulation from BlackRock and paper Bitcoin and everything with the ETF, that is going to directly influence how Bitcoin is viewed in general. And if people view it as an asset to invest in and not as an asset to transact in, the original purpose of Bitcoin starts to lose its steam, right? Because at the end of the day, the end goal would be that you utilize Bitcoin to do everything, as far as pay for everything, and you get paid in Bitcoin, blah, blah, blah. And that's what would shift the power structures. Now, Bitcoin can still shift the power structures without that happening, presumably, right? But it's only going to shift it as much as the tech bubble shifted it, right? It's only going to shift it as much as any new industry has ever shifted the power structures in the past, meaning you still have the problem at the end of the day of just a few people benefiting from it, right? And going to the cream of the crop at the top, right? Your BitBoy cryptos and your Richard Hartwins and your Coinbases. And you have those few things that like blew up and they're at the top and they get to be there, but it doesn't actually trickle down in the same manner. So you have a shift in power structures, but you don't have a shift in power structures that puts the financial power back into the hands of the individual. And there is, question and doubt in my own mind, is this actually going to be successful from that perspective? From the Bitcoin white paper perspective, from a fundamental perspective, is that dream still alive and well? I'd like to hear your thoughts and opinions, of course, in the live chat as well as the comment section below. Now, this is going to be an interesting topic because it's two pieces, right? And I think you'll see why one thing is happening because of what happened prior to that. There is a consensus lawsuit revealing that JP Morgan owns critical Ethereum infrastructure. A group of 35 shareholders of Ethereum giant Consensus AG have filed for a special audit of a 2020 deal that saw JP Morgan Chase acquire an influential stake in two of its flagship products. The former employees, who represent more than half of all CAG holders, want an investigation into the matter, which allegedly saw, quote, fundamental intellectual property and subsidiaries illegally transferred from CAG into a new entity, Consensus Software Incorporated. This was in exchange for a 10% stake in the new entity and a $39 million loan by Consensus chief and Ethereum billionaire Joseph Lubin, according to a press release issued Wednesday. The deal, known within CAG as Project North Star, resulted in financial institutions JP Morgan winning a significant slice in the company's lucrative intellectual property, specifically MetaMask and Infura. Both crypto wallet MetaMask and Node Network Infura persist as arguably the Ethereum ecosystem's most critical infrastructure. Turns out Wall Street fat cats JP Morgan directly profits from and even controls that infrastructure. Not exactly what Satoshi Nakamoto envisioned when he embedded Chancellor on brink of second bailout for banks in Bitcoin's Genesis block. Of course, if we're talking about Ethereum here, we're not talking about Bitcoin. I don't think that there's ever been a question that Ethereum's fundamentals do not align with Bitcoin, never have and never will. And all it really appears to end up being turned into is some sort of huge money laundering scheme that's been going on between, put on the tinfoil hat, right? Between large exchange owners, large traditional financial institutions, and governments. It is what it is. Indeed, Project North Star has proven incredibly lucrative for CSI shareholders like JP Morgan. A year after the transaction, the IP in question was used to raise funds for CSI at a valuation of $3 billion US. After a current round, the consensus spinoff CSI is expected to hit $7 billion. Original CAG insiders reckon the deal was, quote, to the detriment of the minority shareholders of CAG and to the benefit of Joseph Lubin personally, end quote. Ethereum co-founder Lubin is the majority shareholder of CAG and CSI. Forbes values Lubin's fortune between $1 and $5 billion US. The former consensus employees are invoking an article of the Swiss Code of Obligations, which, if successful, may render the deal void. At the time of transaction, both Lubin and board member Frithjof Weinert, were directors of both CAG and CSI. Unfortunately, under Swiss and US law, dual representation in a situation like this is not allowed. The shareholders are also flagging the fact that required annual shareholder meetings had to be delayed by 2 years, meaning that they had no idea the illegal deal had ever happened. Because these meetings never took place, Weinert was supposedly never officially re-elected to the company's board, and so was in no position to authorize Project North Star. In lieu of these shareholder meetings, Lubin hosted an informal informational event in late 2021 at which CAG staff were informed their numbers would be slashed from 160 to 30 by the end of the year. This, coupled with the movement of lucrative assets, MetaMask and Infura, from CAG to CSI, meant a de facto liquidation of CAG without the required consent of a shareholder meeting, according to the shareholders' press release. This was, plaintiffs say, in breach of the director's duty to act in the company's interests, considering it left shareholders holding equity in a company that didn't actually own that much. The shareholders asked anybody who holds or was promised CAG shares to contact them, vowed to, quote, help all those who have been harmed, end quote, and said they're ready for upcoming court battles. For what it's worth, a Consensus Mesh CAG spokesperson told CoinDesk the company refutes the details the shareholders' press release, saying, quote, the business fundamentals and operating environment are entirely different today than at the time of the transaction. Though the group would like to apply a valuation that might be achieved today to a set of projects that were pre-monetization during the darkest days of COVID when the transaction took place. They also said, isn't it funny that it's always like, let's just always use COVID as an excuse. We did something that is ethically questionable, but that was during COVID and it was pre-monetization. Don't worry about it. It's fine. They also said CAG was prepared to immediately file further actions once a Swiss auditor responded to the case. That is pretty funny. And if you want to throw on a huge old tinfoil hat, back that up with this. So we have a bunch of craziness happening here where we have large shareholders like JP Morgan owning a bunch of the infrastructure for Ethereum. And then you pop into the very next article today, just released. Ethereum developers are considering raising the max validator limit from 32 to 2048 Ethereum. This is nutty, guys. Ethereum's core developers are considering a proposal that suggests raising the maximum validator balance from the current 32 Ether to 2048 Ether per validator. This proposal concerns an increase in the maximum validator stake while the minimum would remain at 32. So don't worry, if you can only afford 32, you're going to still be able to do 32. Here's where things get interesting though. Right? It gets interesting. It gets interesting when we start talking about decentralization of the network itself, right? And thanks for the super chat, Theodore. As it stands, Ethereum validators are subject to an effective balance cap set at both the minimum and maximum of 32 ETH. This forces large-scale staking operations to spin up multiple validators if they want to earn yield on any amount greater than this. Of course, what that means is the more validators, the more robust the network, meaning more decentralization, even though it's technically controlled by large individuals, right? Large validators. Like it still helps with the actual network decentralization. So you have more robust infrastructure, right? If you allow people to move that up, you have less robust infrastructure. That being said, unsurprisingly, this practice has led to a big increase in the number of validators. There are currently 600,000 active validators and an additional 90,000 awaiting activation in the queue. Michael Neuter, an Ethereum Foundation researcher and key proponent of the proposed change, made the case for this increase during the most recent Ethereum core developer consensus meeting held Friday. He said that while the current validator cap promotes decentralization, it inadvertently leads to an inflation of the validator set size. Neuter, I feel like that's probably not pronounced correctly. He explained that raising the cap would slow down the expansion of the active validator set, ultimately improving the network's efficiency in terms of achieving finality within a single Ethereum slot. I believe, yeah, so that's not linked here. Yeah, because that finality fail, well, that's a different term of finality than what they linked that article to. Okay. The proposed increased cap will also introduce the possibility of auto-compounding validator rewards, according to Neuter. Should I say Nader? That sounds wrong too. At the present, rewards earned beyond the 32 ETH cap must be redirected elsewhere to generate staking yield. If the cap were to be lifted and raised, these rewards could immediately be compounded, providing validators with an effective means to earn more from their ETH or from their staked ETH. Moreover, the proposed claims to address the operational concerns of larger node operators, including exchanges like Coinbase, which currently maintain tens of thousands of validators due to the existing 32 ETH cap per validator. Raising the maximum effective validator balance would allow such operators to manage fewer but higher staked validators, which could potentially translate into less complexity. He did warn, however, of the associated risks, including potentially higher penalties for accidental double attestations or proposals, also known as slashing, which we talked about as a problem. Imagine you have your ETH staked in like Lido or Coinbase or something like that, and then they get in trouble with slashing. It's going to be pretty terrible. This proposal continues to be under debate among the core developers, who have agreed to further discuss the implementation details of this proposal on social platforms such as ETH Magicians and Discord. What it sounds like to me at the end of the day is really Ethereum is struggling to scale, right? And we've known this for a long time. I think with what was supposed to be coming with sharding, which is still not here, right? Was that, and what was supposed to come along with the move to proof of stake was a scalability and a reduction of fees, neither of which have actually happened. The only thing that's really happened is that we have seen a consolidation of the participants into a few of the very rich and less participation within the community from the miner perspective, and we're seeing less centralization or less decentralization as well, or more centralization, however you want to frame that. It's really, Ethereum has been extremely disappointing to me for quite some time, but it is kind of the de facto go-to for DeFi still, right? Because it's almost like somebody that starts drinking Coca-Cola and never switches to Pepsi, right? It just is the way it is. Even though there could be better solutions out there, there are even proof of work solutions out there that are arguably better, but the thing is everybody's accustomed to the current status quo with Uniswap, etc. We'll have to see if that continues though, right? Giants have fallen in the past. I'd like to hear your thoughts and opinions down in the description, or down in the comment section below, as well as the live chat. Crypto detective ZachXBT faces defamation lawsuit. Machi Big Brothers has sued ZachXBT for an investigation the latter published in 2022 of June, alleging the trader stole tens of millions of dollars worth of crypto. NFT trader Machi Big Brother, otherwise known as Jeffrey Huang, has sued ZachXBT, an independent blockchain detective, after the on-chain sleuth published a report last year alleging he embezzled tens of millions of dollars worth of crypto. The lawsuit, filed on Friday in the U.S. District Court for the Western District of Texas, alleges ZachXBT defamed Machi Big Brother, inflicting serious reputational and monetary harm on him. ZachXBT faces 1 count of libel and 1 count of libel per se, according to the complaint. Quote, without any regard for the ruinous effect that public allegations of criminal conduct can produce for the accused individual, ZachXBT not only proceeded to publish his defamatory article on Medium.com, but he also maliciously promoted the article to his more than 300,000 Twitter followers, Machi Big Brother's lawyer said in the complaint. Machi Big Brother's lawyer did not immediately respond to requests for comment. The lawsuit cites an investigation ZachXBT published on his blog and on Twitter in June of 2022, alleging Machi Big Brother manipulated crypto markets and embezzled 22,000 Ether, worth nearly $38 million at the time of writing. ZachXBT responded to the lawsuit on Friday, calling it a classic David and Goliath story. I mean, ZachXBT is kind of a Goliath in my humble opinion, as far as like clout on crypto Twitter. So I wouldn't really call it a David and Goliath story. Plus, you know, we'll get into his fund and all of that. People are going to fund him. ZachXBT has done great work on, you know, exposing scams, etc. If you don't follow him on Twitter, I highly recommend it. That being said, I have seen him kind of go a little too hard at people that I think weren't actually doing anything, at least maliciously incorrectly, but probably incorrectly at the same time. But that's kind of Twitter. That's the game of Twitter, right? Where things are a little bit more blown out of proportion, let's say, when you get into these topics. Quote, my understanding is that Machi Big Brother is very wealthy. ZachXBT tweeted. He did say, I am not. Yeah, but you're extremely wealthy from the perspective of actual like clout, resources, that sort of thing. I think what you'll see here is he's going to be able to use these resources to take care of this. I mean, in general, when you talk about, you know, wealth, I did want to bring this up because it's kind of interesting. Like, there's like the, you know, your physical wealth, there's your mental wealth, but there's also like this, we have this online clout wealth, we have, you know, the subscriber count wealth. There are ways to leverage that to also just get material wealth, like money and all of that sort of stuff. And that's what he did. This is why building a brand around yourself is so powerful. This is why, you know, creating content that serves the public is, you know, extremely powerful. So like, I've never heard of Machi Big Brother, I guess is my point. I've heard of ZachXBT. Just my perspective there. I definitely couldn't be on the jury if this went to a jury trial. In the same Twitter thread, the crypto detective lamented that fighting the lawsuit could cost more than $1 million. He asked his followers to donate crypto to a wallet dedicated to his legal costs. Quote, I'm asking for your help so this doesn't happen and the truth survives, he said. The wallet has racked up almost 95,000 worth of crypto donations as of publication time. The complaint requests the court order ZachXBT to pay, quote, actual and compensatory damages, in addition to exemplary damages of an amount being to be determined by the court. It also requests that Jeffrey Huang be reimbursed for any legal fees he racks up during the impending legal battle. ZachXBT will not pause his investigative work as he prepares to defend himself against a lawsuit. His lawyer, Brown Rudnick, partner Stephen Pally, told CoinDesk. Quote, to my knowledge, our client intends to carry on with his work, so I'm glad to see that, Pally added. Yeah, we intend to vigorously defend this lawsuit and protect ZachXBT against this attempt to chill his free speech. End quote. ZachXBT skyrocketed to prominence within the crypto community after publishing original blockchain data analysis, allegedly exposing the misdeeds of bad actors populating decentralized finance and Web3 spaces. His investigations have helped him amass a following of more than 400,000 users on Twitter and earned him a spot on Consensus Magazine's most influential 2022 list. Billing himself as the on-chain sleuth, ZachXBT often publishes the results of his investigation in Twitter threads and blog posts on Medium. And I bring this up because I do have like a lot of influencers follow me, I think, in general, that are, doing the crypto mining thing and whatnot. And I've made a lot of mistakes in the past too, but you want to be extremely careful with how you present things, I think, when you're trying to expose. I see a lot of people always trying to expose stuff. I think you got to be extremely careful there, because you never know if you're going to be incorrect or like end up being in a position where you could put yourself in a position to go, be under a lawsuit. That being said, I don't know the details of the actual research that was presented by ZachXBT. But like I said, I have seen him go a little too hard on people in the past. It looks like we do have that article here. And it does have all the chain analytics. So if you guys want to check this out, I'll leave this in the live chat. I thought it was interesting. I also just wanted to give a shout out to ZachXBT, so you guys follow him so that you can avoid scams, etc. in the future if you're looking to do that. Bitcoin infrastructure firm Blockstream to unveil its long-awaited mining rig in Q3, the third quarter of 2024. The company expects to raise more capital to fund its mining business. Bitcoin infrastructure firm Blockstream expects to unveil its long-awaited ASIC miner, a culmination of years of engineering work, around the third quarter of 2024, according to Blockstream CEO and co-founder Adam Back, during the company's first ever media briefing on Tuesday. The company acquired Israeli mining hardware manufacturer Spondulis in 2021 and brought the manufacturer's core team into Blockstream's mining division, which is headed by Chris Cook, with former Spondulis CEO Asaf Gilbow, something like that, serving as executive vice president. In January of 2023, Blockstream raised $125 million to expand mining operations and says it plans to raise even more capital to fund its mining business. The new ASIC was originally slated for 2022 launch, but Back now anticipates having the miner available in the latter half of 2024. There's two rough approaches to manufacturing. One is to do a shuffle run first, which is kind of a test run, Back told CoinDesk during the briefing. So that would be the miner into, put the miner into sort of the Q3 next year, roughly. Now, I had kind of wondered where this company went, because I knew that we were going to get more competition within the ASIC miner manufacturing realm, and I was expecting to see that. I think last year even we didn't see it. This is the first I've heard of them actually coming back out with it. Obviously, any more competition within the ASIC market is invaluable. One of the things that I did, I'm struggling here with as a GPU miner I think not only from the perspective of like the fundamentals and decentralization and all of that, but the fact that GPU mining is not profitable. as or near as profitable as ASIC mining, right? But the GPUs are more expensive than ASICs now, which is, I mean, like you can get entry level ASICs, the same price as you can get a GPU, and they're more profitable. But then we're moving into this proof of useful workspace, which is like pushing everything into like data center infrastructure style cost. And I'm sitting here wondering, like, it seems like the shift is like home miners for GPUs are just gone, and it moves into like this ASIC realm is more attainable from the perspective of trying to build asset wealth over the long term. And I don't know how this shift kind of plays out or how this started to happen, but it seems pretty obvious that that's kind of what is happening now at this point. And I think if we continue to get more ASIC manufacturers and more availability internationally, I think you'll see this start to become, more of what I think the YouTubers talk about. I think like a lot of the mining YouTubers or whatever, like myself, will be talking more about ASICs as opposed to GPUs. I think GPUs will always play a part to a certain extent, but we also have to talk about the fact that like AMD and NVIDIA are just making less units, and when their units don't sell, they don't drop the prices. I mean, from a PC gamer perspective, it seems dumb to even buy a PC game or a PC for gaming at this point either, because you might as well just buy a Series X for $500. It just seems like the GPU market has 3 competitors now. We were hoping, Intel's kind of added some competition, at least within the mining realm, but we're getting more competition on the ASIC side of things than we are getting on the GPU side of things. Speaking of GPUs, NVIDIA RTX 2080 Ti gets 44 gigabyte memory mod. This is pretty crazy. CAT mod team puts 44 gigabytes of memory on an RTX 2080 Ti. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 2 gigabyte sticks or modules. Pictures and screenshots shared by CAT gives us the very first look at the special GeForce RTX 2080 Ti graphics card. The Turing architecture may have already been 5 years old, but the flagship gaming card from that generation should still give great results. Turns out they were able to add 44 gigabytes of GDDR6 memory to this card, which originally features 11 gigabytes across the 352-bit bus. I got that wrong. 1, 2, 3, 4, what is that, 12 to 44? How much is each module? Got that wrong initially. And there might be some on the back too, huh? Might be some on the back. But check this out, guys. This unusual memory design offered up to 616 gigabytes of bandwidth, which is on par with modern graphics cards. That's pretty crazy. That's more than the new Intel GPUs. That's more than the 3070. And then if you look at that, so I did do that run out for you guys just for fun. On Ergo, a 2080 Ti does 114 megahash a second, for example. And you have a 175% increase in memory bus bandwidth, which means you would basically take the hash rate on a 2080 Ti on Ergo up to 200 megahash a second. I mean, similarly, you would get it, 100 over 100 megahash a second on Ethereum. So that's pretty dang cool, dude. As modders have explained, they used the lead tech RTX 8000 PCB and replaced the GPU with the TU300A RTX 2080 Ti. Such a mod took many attempts, 7 in total, and requires both a custom BIOS and drivers to work. The GPU Z output confirms the 44 gigabytes of memory is installed at full bandwidth of 616 gigabytes a second. So there's more on the back. 1, 2, 3, 4, 5. Yeah, there's 12 more on the back there. So they put 12 on the front, 12 on the back. So a total of 24 modules, it looks like. It appears that the card used for this mod was manufactured by Lead Tech, who are using NVIDIA reference PCB design for the card. Even though GPU-Z and DirectX diagnostic info screenshots were shared, the card does not actually work in games or benchmarks, as confirmed by the poster. Memory modded GeForce cards may require custom BIOS or special NVIDIA control power profiles, which is a common issue. Anyways, I thought this was super neat that they did this. It would be cool to see, the gaming benchmarks. If, theoretically we could get it working in mining rigs, you would see a crazy increase in the mining, hash rate on at least memory intensive algorithms, not on anything else. Dynex would be a really interesting one because that scales with amount of memory, not necessarily just the bandwidth. In fact, bandwidth doesn't really affect Dynex that much at all. So you could see, a 4x increase in hash rate on the 2080 Ti for this, putting it up to like what? Like, what was that? So 5,000, or that's 6,000, so 12,000. 24,000 hash a second on Dynex. That would be pretty insane. Speaking of though, let's go ahead and get into this. Profitability, not that good. GPU mining profitability has just been abysmal, and it's going to get even worse because the fact of the matter is Radiant already has its Bitstream profiles rumored and ready for launch. We already have, the Team Red miner ready to go. The E300s are getting support for it. It's going to push GPUs out, and it's the most profitable on GPUs right now. It sucks. And this is just par for the course across everything. And the only thing, like I said, this is the concern I have with GPUs. The only thing at the end of the day that's going to be left over is going to be proof of useful work. And proof of useful work is going to cost an arm and a leg from an infrastructure perspective. There are going to be ways that we'll figure out to reduce the cost of this in general, I'm sure. I'm excited to do it. But there is this little bit of reluctance of like, is this the most effective manner in moving forward with something like a mining farm? Are GPUs really practical at this point if I'm dumping all that money into it? And if I'm going to dump all my money into AI rendering farms, essentially at this point, why am I not just we're cutting a deal with an AI company right off the bat, cut out that middleman, get rid of the fees, and not worry about the mining taxes, right? I mean, it seems like it would be stupid to do it in a manner that just tanks your profit all over the place, especially if we end up like on stateside getting a 30% tax on our mining revenue. It's just something I've been thinking a lot about. I know people say I'm a little bit of a downer from that perspective, but it just feels like that's the times are changing. We got to figure out how to change with it. But I don't see, I don't see it being super profitable. Definitely not as profitable as the Antminer KS3, slated for launch in August, mining kaspa at $2,610 a day. What's even more incredible is the KS2 is still making $627 a day. Of course, this is with the absolute massive pump that we saw over the last week in kaspa, going up back over 2 cents per kaspa, and is up 24%, 25% over the past 7 days. And even seeing the shipment of the KSOs hit the market. And I believe what we did see as well with that, which is extremely interesting, is that we saw the hash rate go up about 10%. Now it's looking at about 16, 15% up on the network hash rate, which obviously does drive the difficulty up theoretically, but it's not looking like it's that far up right now. So, it seems like pretty crazy profitability right now on anything that mines kaspa. These ASICs are absolutely insane. I've heard rumors of sales coming from Ice River here as well. So I think they're trying to get rid of their batches before this August launch of the KS3. And other than that, I mean, the most impressive miner I think that I've seen over the past year during this bear market has been the Antminer L7, which has just steadily been profitable and really not moving a lot. So the Antminer L7 definitely been out for a while, remain profitable, you know, seems like a solid choice for the shitcoin miners. Scrolling down from there, taking a look at the S19 Pro, we're still negative on it, right? We've been tracking this for like 4 years now. It's losing like 44 cents a day, 50 cents a day at 10 cents a kilowatt hour. But there are more, you know, there are, for Bitcoin mining, there are more efficient miners out right now. Also, even the S19 Pro, there are a lot of options for overclocking, underclocking, low power modes, and all of that. I'll be covering more of that on this channel, so definitely stay tuned. Other than that, taking a look at the proof of work coins over the past 24 hours, the largest pump is Radiant, up 14% over the past 24 hours, with Ethereum proof of work coming in at 11.65% over the past 24 hours. Everything else under 3%. Over the past 7 days, Dynex had a pretty crazy run, going back over 25 cents, up 44%. We have Ethereum proof of work up 25% over the past 7 days. And then, of course, kaspa, like we talked about, up 25% over the past 7 days. Let's get into questions and answers. Remember, super chats are never required. Always appreciated first to be answered because they're the easiest to read. In addition to that, tag @SonOfATech highlighting the message orange, and I'll be able to read it easier. I'm going to use the bathroom break while we run the ad and give you time to get your questions in. Today's sponsor is BT Miners. BT Miners has been a longtime sponsor of the channel and a proven reliable source for ASIC miners. If you're looking to purchase ASICs hardware from Bitcoin to Dogecoin miners, they are available for purchase on bt-miners.com. BT Miners is a trusted source by both ASICminervalue.com and CryptoMiner.com. Follow the affiliate link in the description and tell them SOT sent you to support the channel. All right. Looking good. Son of a rabid panda, nice name, says @SonOfATech. Hello, my mentor. Oh no, I'm not your mentor. Choose Jesus Christ or Buddha, bro. Matt K says, @SonOfATech, do you still expect kaspa dump in August? Do you think it'll go below 1 cent? I said, could it go below 1 cent based on, of course, the calculations compared to what happened with Kadena, right? And yes, I do think that that is still a possibility. We're still waiting on the KS3s to actually come onto the network. And then we're waiting on those KS3s to be packaged up and shipped. And then we're waiting on, after everybody gets them in August, if they get them in August, which I would presume we see a 3 to 4 month delay, if we're being completely honest, right? That's what we saw, you know, in the past. But we'll probably see some sort of delay on them. And then if we see the delay on them, we'll start to see all of that hash rate come online, right? So August, maybe August, we see all of this hash rate come online. We see a delay, and then we see the subsequent push out of the miners. We see Bitmain get rid of their kaspa, and then what we see is probably all of the miners begin to race to ROI, right? And that's really what causes the price to go down, is the race to ROI, right? If you're spending $62,000 a pop shipped, and you aren't racing to ROI your machine, then there's a high likelihood that you'll be screwed, right? And so this is really where a lot of people will, I think, just don't take into account the fact that miners are going to be trying to ROI faster than the competition. And if they don't, to be fair, they could end up in a position where a lot of the Kadena ASIC purchasers have ended up now too. So, you just want to be cognizant of that, because it is just part of the way the network effects have functioned in the past, right? It's not saying KAS was a bad project. It's not saying KAS was going to crash out and never be worth anything. It's not saying any of that. It's just saying the network effect of the way people react when they are purchasing large machines and trying to pay them off, how they affect the network and the price, right? Eventually. Gordon says, what do you think about buying kaspa ASICs? Well, it's up to you. You know, I think I was erring on the side of Ice River being, scammy to a certain extent. They clearly were not. So I misread that, for example. I think the people that purchased the KSOs are looking pretty good at like 26, 30 bucks a day, and are going to be able to pay those off in a timely fashion, right? Hopefully, obviously, before the KS3s come online. But you are going to get it, like, that ASIC game outside of Bitcoin turns into some sketchiness, right? Like, you see the IB Link BMK3 launch, and then right after that, the KA3, and you end up not making any money, right? And this is like personal experience with getting into the ASIC market on shitcoins. Like, I've stopped buying ASICs for shitcoins, because the fact of the matter is that it's always this revolving door of like newer, better, faster, more powerful, higher ROI, stuck with a shitty brick unit. That's what it turns into. And seeing that KAS was very, very, very early in ASICs right now, we're already seeing it, right? KS1, KS2 launch, KS3 launch, right? Like back to back. I mean, to the point to where if you paid the $30,000-$40,000 for the KS1 or whatever it was, or the KS2, and then the KS3 is launching here, and you don't ROI that in time, you're in a pickle, right? So this is the problem. This has always been the problem with ASICs on these coins, and I mean it's even a problem with ASICs on Bitcoin, just not to the same extent. And Bitcoin ASICs have started getting a lot of outside support that allows for a little bit more maneuverability, with like control boards offering better hash rates at lower power consumption on older units, for example. I mean, there's S19s out there now that like 100 terahash models that are overclocked, immersed, or water cooled, getting close to breaking 180 terahash a second, that sort of thing. So you get that extra, from a mining perspective, you get that little bit of extra support, right? Whereas, I have a dead Antminer D9 right now, and like getting that getting that RMA'd, and like the day I got it, the network goes down, and then it runs for a couple weeks, and then it just dies, and then there's not very many of them, so getting them shipped out and getting them repaired and all that is just a pain in the butt. I mean, these are just things that when you're buying ASICs for coins that are not, if it was an Antminer, and this is Antminer, it's Bitmain, it's a large unit, right? If it was an S19X, even an XP Pro, which break a lot or something, finding somebody to replace or repair it's going to be easier. The likelihood that parts for return or RMA through the company that I purchased it through is going to be a lot higher. On my getting back up and online with any of those is going to be much better. So I don't know. These are just thoughts. Hot Crypto Mining, thanks for the $4.99 super chat. Says, hope you're good, brother. Checking on you. Content Creators Unite. Make sure you guys go sub to Hot Crypto Mining. Thank you, good sir. Broski says, ask Tech, will you run SHA-256 ASICs till the Bitcoin halving? I probably won't be running them, no. I'm running a couple, but only for testing. All right, boys. That looks like that is going to cover that. I am going to head on out and get off to the yoga, I think, here in a second. And it's only 7, so I'm going to eat food. But thank you, everybody, for hanging out. Be sure to hit the like, comment, subscribe, and notification bells down below. And I will see you next Tuesday.